Hello and welcome to Premier Study in Investing. It's great to have you. Thanks for stopping by. Okay, hey, welcome back to Premier Study in Investing. Today we're going to be looking at the actual performance of a portfolio I've built using modern portfolio theory, using the same models that I'm putting on Patreon each quarter. So for those of you who are not familiar with that, it's all 11 sectors. There's 2 ETFs for each sector. So 2 times 11, that's 22 funds that we start off with to make sure that we have 2 different shots at each sector. These are highly liquid, hopefully very low expense ratios. So we start with those, and to that we add gold, we add corporate bond fund that's investment grade, we add a corporate bond fund that's junk or non-investment grade, we add a emerging markets, not including China fund, and we add I can't remember the ticker for it, but it's the Vanguard U.S. All Equity Fund. And the reason we put that in there is because so many of the FIRE community, the Jim Collins crowd, if you're familiar with that, FIRE is an acronym for Financial Independence, Retire Early. And Jim Collins is an author, older gentleman, and he basically recommends for people, given that they're trying to reorganize their work life and their expenses and their budgets and their goals and their ambitions in an attempt to retire early, that the stock market investing piece is pretty overwhelming for people. And so he just says that use this very cheap all equity fund put out by Vanguard that captures essentially all the publicly traded companies that are US based. So we look at all those and then run it through this model, and we optimize basically for the return to a standard deviation trade-off. This is the Sharpe ratio, if you're familiar with it. So to be a little bit more specific, it would be the excess returns that you would get above the risk-free rates divided by the standard deviation. And so that's basically what we're doing in Excel. And so I had been running a 12% expected return portfolio, and I wanted to show you how it's performed and underperformed and barely overperformed, basically the timeline and what that looked like. So if you deploy one of these, I guess the big takeaway is if you deploy one of these strategies, you need to realize that it's the long term, I guess would be like this direction, the long term slope, hopefully positive because you're looking for positive returns, but there's going to be a lot of ups and downs, peaks and valleys along the way. Okay, so this is Schwab. They have a portfolio return tool, and you can see I named this portfolio Roth IRA 12% Modern Portfolio Theory. So using Modern Portfolio Theory, hoping to get the 12%. I just went to max for the date, and so I just started in May of 2023 and have run it out today. So rate of return, your account has a cumulative rate of return of 16.93 from May 20th, 2023 to September 29th, 2024. So annualized, that's 12.14%, which is what we're shooting for with the 12%. Now, what's really interesting is, just for frame of reference, S&P, it's risen dramatically over the summer with, I think, the market looking for central banks to cut interest rates. If you know anything about how equity is valued, the cost of debt or the interest rates usually matter a lot in those models. So it's close to all-time highs on the S&P 500 at almost 5750. Anyways, as you can see here, since we started, flat up a couple percentage points, so I didn't know it had this option. But yeah, after a couple months, we start to fall into negative territory after that, down as low as negative 9%, right? Well, what happened was I went with the long-term treasury fund. There's 2 options that I mentioned, and I suggest that since there is some disagreement within the finance community, according to Mark Meldrum, and then what I learned in graduate school, one would say you should use T-bills, which T-bills is basically the shortest duration type of U.S. Treasury instrument that you can get. So some people say use the super short stuff, and other people say no, that in industry, professional portfolio managers will tend to use something a little bit longer in duration for their risk-free asset, as usually longer term instruments do provide a little bit better return under normal circumstances when you have an uninverted yield curve. So when I went and built this course and then I say, you should either pick between something short like BIL or SHY or something longer term like TLT. Well, I was picking something longer like TLT for the risk-free assets, and well, it went down from when I bought it. Rates continue to climb, so I was a little bit early on when I thought rate cuts were going to begin. But anyways, I mean, down 8.52% as you can see on the screen. So that's not good when you've built a portfolio, you're expecting 12% annualized return, and you're not only just in negative territory, you're like really in negative territory. So that might have had to do with some other kind of sell-offs, but eventually it does break even. That's a couple months though in negative territory, or basically like zero return, which is not good. And then as I was just looking at this, don't really break up over the 10% return until a year later. So it was over a year from May to June of not hitting what we expected based on 5 years of historical data. And then finally we've had some ups and downs, but obviously the summer has been good for stocks, and also as you know, for those of you that are familiar with bond valuations, there's been expectations, but there also has been actual interest rate cuts. And even before the Fed decreased rates in September 2024 officially by 50 basis points, the market was already pricing in. You were already seeing lower yields come in on the 10-year and other medium and long-term duration bond or bond funds. So that all helps, right? I mean, the increase in the equity prices and the increases in the bond fund, that helps. So I'm assuming that a lot of people have had a good summer, right? But I just want to make the point that you're looking for, basically 12% is a slope, right? Up 12 percentage points over every year, right? Well, you can see there's a lot of ups and downs in that type of thing, and this is probably more the consistency that you're looking for. But I guess just the point is what I'm learning, sort of applying the theories, is that, yeah, it's nice to see. Did I kind of cherry pick the moment? Yeah, I mean, I did kind of, I was like, okay, just like I don't want to look at this thing when it was in the red, and then as it started to perform better, as I would check on it, I said, oh, okay, well, like this is good finally, right? And then I guess, I mean, honestly, like most people, you're embarrassed, you don't want to brag about your losses, but then it's also, everyone talks about how disingenuous it is to start talking when things are going well. It's I guess this is a picture of when it was going well and when it wasn't, and I'm making this today when things are good. Oops. And I'll leave the information in the show notes for how you can access the course, get a hold of the Patreon models, etc., etc. Now you have a little bit better idea of some of the choices you need to make for your risk-free asset, as well as some of the volatility that you might expect over time, and that not only will you maybe undershoot your expected return, it's possible it could be in the negative, right? So that's like not what I was expecting at all when I built that. And I guess I should definitely say there's some surprises. There's some surprises in what was chosen by the model for me, as well as the ones that really performed well for moments, and then some of the changes that came along in subsequent quarters, especially in subsequent quarters. It's been interesting. So I'll just leave it there. I probably talked for too long. Thanks for joining me. How's it going in the workforce? I'm always curious to know layoffs and these types of things. I love to ask people, are we in a recession? What do you think about that? And then if you're stock picking, what's your methodology for that? Also curious to hear if anybody, I think for both July and August, Moderna was the most heavily shorted stock of all of them. So if you have any Moderna shorts out there, tell me what you think. That's interesting as well. Okay, well, thanks again. Bye.